My view is that the world has been in a depression since 2007 and will remain so for an indefinite period of time. And when you say that, people are, wait a second. Yeah, we know the definition of a recession. The technical definition of a recession is 2 consecutive quarters of declining GDP, rising unemployment. There's a few other bells and whistles. There's a little bit of subjectivity to it. The National Bureau of Economic Research, or the unofficial but widely followed referees on when you're in a recession and when you're not. So, like, wait a second, how could we be in a depression if we're in the 10th year of an expansion? Debt to GDP sky high, economy weak at best, probably had a recession in the first half. Maybe that's continuing. Um, People talk unemployment close to an all-time low. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working. Prime age 25 to 54 years old. It's never 100. I mean, there's always, you could be a homemaker, a student. They're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. The baseline deficit is $1 trillion. So your deficit's out of control and your trade deficit's out of control. The answer is that people don't really understand the definition of a depression. They assume intuitively, well, if a recession is 2 quarters of declining GDP, and a depression sounds worse, it must be 6 quarters of declining GDP. Well, we haven't had that. As I say, we're in the 10th year of an expansion. But that's not the definition of a depression. The definition of a depression is a sustained period of below trend growth with no particular tendency to collapse or getting back to trend. In other words, if trend growth, I'll use the United States, but you can apply this more broadly to the world. If trend growth is 3.5%, and that's probably the long-term potential of the United States. You can higher nominal growth with inflation, but we're talking about real growth. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession, but you're in a depression because you're not getting back to that trend. Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything, because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like, it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. And people say, well, 2%, 3%, it's 1 percentage point, who cares? No, that gap is huge. And because of the compounding effect, think of it as a wedge. Here's the trend line, here's the actual line. That wedge gets bigger. So we're 10 years out, we've left $5 trillion of potential growth on the table. That's the output gap, or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. By the way, that definition I gave, a sustained period of below trend growth, that's not my definition. John Maynard Keynes came up with that definition in the 1930s. It was good enough for him, it's good enough for me. I think it's accurate, but being objective, using the numbers I mentioned, we're in a depression. We're going to stay that way. The United States is Japan. The real danger is not that they don't have a trick or two up their sleeve, but that they can't step off the stage. They can't withdraw from market manipulation, policy rate manipulation, money supply manipulation to try to prop up the economy. They would love to kind of go to the sidelines, have what they regard as a theoretically neutral rate, maybe intervene if there's another crisis or another recession, or cool things down if there's inflation, but otherwise just kind of go on autopilot. That's what they would like to do. They can't do that because they're in so deep, they can't get out. Now remember, QE
ended in 2014. The interest rates started increasing in 2015, so that was the beginning of tightening. It was very slow at first, but they picked up the tempo in 2017, 2018. And the quantitative tightening, I run into people all the time who go, I hate QE. I said, well, sorry, QE was over 4.5 years ago. We're into QT, quantitative tightening. So you were getting a double whammy. They were raising rates 25 basis points every quarter like clockwork, and they were burning money. Remember the famous cartoon of Bernanke hanging out of a helicopter, like a manic look on his face, throwing dollars? That was QE. Picture Jay Powell at a furnace with a pile of $100 bills, shoveling the money into the furnace, because that's what they're doing. They're burning money, reducing the base money supply.
You know, Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their third lost decade. The United States has had a lost decade from 2007. We're probably, if something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. You know, people say, oh, well, you know, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes. You get a real good, 4% print, and then the next quarter is 2%. The one after that is 0.5 or maybe even a negative quarter. So the headwinds, demographic, technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse. It looks like we're heading for a global debt crisis. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023, and no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think.
And then they ramp up the printing press again, Jim.
Yes, but it doesn't work. $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. We're looking at a global recession, and those are rare. As I said before, it's one thing if Germany has a recession or Japan or the US, but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody's declining are rare, and that's what's happening. And that's what we had in 2008.